What is the $1.5 trillion housing subsidy? Define the stack. Let's define what that $1.5 trillion actually is. We're not talking about stimulus checks or direct grants. This is a stack of recurring tax expenditures. Money the government doesn't collect because certain housing activities are favored in the tax code. It's real subsidy. It just flows through the IRS rather than a housing agency. And the simple, uncomfortable truth is, the tax code picks winners. Homeowners and landlords qualify by default, renters don't. Start with the mortgage interest deduction, the MID. If you itemize, you can deduct interest on qualifying mortgage debt, currently capped at $750,000 for new loans under current rules. A deduction isn't a dollar-for-dollar credit. It reduces taxable income, so the benefit scales with your tax bracket. Higher income, bigger tax savings. In practice, that means people with larger mortgages and higher marginal rates typically capture more of the MID than entry-level buyers. After the 2017 law doubled the standard deduction, fewer households itemize, but for those who do, the MID still matters, especially in high-cost markets with larger loans. Layer 2 is state and local tax deductibility, SALT, where applicable. There's been a federal cap in recent years, but when property taxes are deductible, the after-tax cost of owning falls relative to renting. Again, the pattern repeats. If you itemize and your income is higher, the deduction usually helps more. In some states, property tax systems are structured in ways that can be regressive across neighborhoods, adding another tilt inside the tilt. The second big engine is tax-free gains on the sale of a primary home, known as the Section 121 exclusion. Meet the basic use and ownership tests, and you can exclude up to $250,000 of gains if you're single, $500,000 if married filing jointly. In places with chronic scarcity and high appreciation, that translates into six-figure tax-free wealth transfers. When a household can realize large untaxed gains, you create incentives to stay put for at least the qualifying period and then time exits for maximum windfalls. That reduces churn in starter homes and amplifies price pressures where supply is tight. Add in step-up in basis at death, and appreciated property can pass to heirs with gains wiped up to the date of death value. Wait, what? A lifetime of gains can legally vanish at death. No capital gains tax on that appreciation. That's a powerful intergenerational wealth accelerator for homeowners, something renters never access. Next, the subsidy you never see, imputed rent. If you own, you get housing services from your home, effectively rent you pay to yourself. In the US, those housing services aren't taxed, while renters pay landlords with after-tax income. Same house, different tax bill. Combine untaxed imputed rent with deductible mortgage interest and property taxes in certain cases, and the after-tax cost of occupying a home diverges sharply from renting, especially at higher incomes. Wait, what? You pay taxes on the money you use to pay rent. Owners don't pay tax on the housing service they consume. On the investor side, depreciation is the quiet workhorse. Landlords can deduct non-cash depreciation against rental income, even when the property is appreciating in the market. Paper losses can offset real cash flow, lowering taxes today and enhancing returns. Then there's the 1031 exchange. Sell an investment property, roll proceeds into another qualifying property, and defer the capital gains tax. Do that for decades, and the unpaid tax becomes growth fuel for the next deal. Defer long enough, pass away, and step up in basis can erase a lifetime of deferred gains. Wait, what? Taxes deferred for decades can disappear entirely at death under current rules. That combination rewards holding, scaling, and consolidation, which can mean fewer single-family homes returning to the owner-occupant market. Put this all together, and you get the stack. It's not one policy, it's the interaction. Deductions and exclusions boost purchasing power for those already inside the system. Investors get deferral and shelter. Owners enjoy untaxed housing services. Renters get none of it, yet they still support public services through income and consumption taxes, and often rising rents that incorporate higher property costs. Why call it hidden? Because it doesn't show up as a monthly benefit. It shows up as a lower tax bill, a bigger after-tax refund, a closing check with a six-figure gain that isn't taxed. The budget tracks these as tax expenditures, revenue foregone. When you add the major homeowner subsidies, the investor side preferences, and the untaxed imputed rent, the number gets enormous. Villain check. It's not your neighbor or your parents. It's the rule book they were handed. And yes, distribution matters. These benefits skew toward higher incomes and higher value properties because deductions scale with tax brackets, and the biggest gains show up where prices are already high. Under conditions of scarcity, that demand-side boost doesn't create homes. It gets capitalized into prices. So if you're wondering why doing everything right still isn't enough, this is a big part of the mechanism. In a second, we'll contrast the original promise of these policies with the reality of scarce supply, and why good intentions turned into price inflation. The original promise versus today's reality. After World War II, homeownership wasn't just a financial goal, it was national policy. The promise was simple: stable jobs, standardized mortgages, and a tax code that made owning a home the foundation of middle-class wealth. The 30-year fixed mortgage spread risk over time. The GI Bill opened credit doors. Highways made land cheap at the edge, and zoning locked in quiet, single-family neighborhoods people could count on. Policy built a ladder, and the rungs felt evenly spaced. The tax code's role fit that world. When land was abundant and building was relatively easy, nudging demand with deductions and exclusions helped people climb onto the ladder without blowing up prices. The mortgage interest deduction lowered carrying costs. Property tax deductibility softened the hit. And if your home appreciated, you could sell, bank gains, and upsize without a nasty tax bill. In a world of growth, sprawl, and elastic supply, those subsidies mostly boosted access. Then the ground shifted. Over decades, local rules narrowed what could be built where. Single-family zoning dominated large swaths of cities and suburbs. Minimum lot sizes, height limits, and parking mandates pushed up the cost of each new unit. Environmental and permitting processes added time and uncertainty, which translated into risk premiums. Meanwhile, incomes for many households decoupled from land-constrained housing costs. Scarcity replaced abundance. Here's the pivot point most people miss. Tax breaks designed for an elastic market behave very differently in a constrained one. When you boost demand in a market that can't add supply quickly, the subsidy doesn't create more homes. It bids up the limited homes that exist. The benefit gets capitalized into land prices and sale prices. Sellers and existing owners capture more of the value than the buyers the policy was meant to help. You can see the mechanism. The MID reduces after-tax mortgage costs, so buyers qualify for slightly larger loans. In a tight market, multiple bidders show up with the same extra purchasing power. List prices ratchet upward to meet that new ceiling. The Section 121 exclusion does something similar at the exit. It makes large home sale gains tax-free up to a threshold, which encourages holding until a bigger payout is likely. Fewer owners list starter homes. Lower turnover means less inventory, which supports higher prices for what's left. Now layer in the incentives. If your neighborhood is mostly homeowners, their rational vote is to protect values and keep density low. Local policies follow. With limited new construction, investors chase the same scarce units because depreciation and like-kind exchanges sweeten returns on the rental side. Rents rise as property values rise because landlords price to the market and to higher financing and tax-adjusted costs. Renters absorb it with post-tax income. Owners, meanwhile, enjoy untaxed housing services, deductible costs in some cases, and tax-advantaged exits. The result is a feedback loop. Subsidies tilt the after-tax math toward owning and holding. Zoning and permitting restrict how quickly new inventory can appear. Capital flows chase yield in housing because policy makes returns more predictable after tax. Each piece amplifies the others. Prices rise faster than wages, entry gets delayed, and the ladder's lower rungs stretch farther apart. You might be thinking, weren't these policies supposed to create a stable middle class? They did, under different conditions. The post-war era paired buyer support with massive building at the fringe. Today, the fringe is either built out, blocked by rules, or too far from jobs to make sense. Demand support without supply growth is like stepping on the gas with the handbrake on. The engine revs, the car doesn't move. There's also a timing issue. Credits and deductions hit immediately. Supply takes years. In hot markets, a temporary demand boost can create a lasting price jump because comparable sales reset valuations, which feed appraisals, which justify higher loans, until the next cycle. Even well-intentioned first-time buyer assistance gets partially captured by sellers when listings are scarce. If you remember nothing else, remember this. The original promise assumed we could build fast enough to meet subsidized demand. Today's reality is that we can't or won't in most places. That's why the same policies that once broadened access now entrench advantage. They deliver the largest benefits to households already on the inside, especially in high appreciation areas, and they do it in ways renters can't tap. So when people say, just help buyers more, the question has to be, where do the new homes come from? Without supply, most help becomes price. And that's the uncomfortable bridge from yesterday's promise to today's reality. Now let's zoom in on the biggest demand engine, the mortgage interest deduction, and why it reliably shows up in higher prices, not lower ones. The mortgage interest deduction, how it inflates prices. Let's get concrete about how the MID actually works in the real world. A deduction lowers your taxable income, not your tax bill dollar for dollar. So a $10,000 interest deduction is worth $2,200 to someone in the 22% bracket, $3,200 in the 32% bracket, and more at higher rates. That simple math means higher income buyers with bigger mortgages capture larger benefits. And since loans are capped for deductibility at $750,000 of principal under current rules, the largest practical gains still cluster in high-cost markets with bigger balances. Now here's where most people mess up. They assume lowering after-tax carrying costs makes homes cheaper. In a constrained market, it does the opposite. The benefit gets capitalized into prices because multiple buyers show up with slightly more room in their budget. Sellers and listing agents quickly discover the new ceiling and price to it. Over time, appraisals follow comps, lenders follow appraisals, and the whole stack ratchets up. The deduction meant to help buyers ends up helping sellers capture the subsidy in higher sale prices. The thing most people miss is the leverage incentive. When the government makes interest cheaper after tax, buyers stretch a bit more. They accept a larger loan, a longer commute, or a pricier neighborhood because the net monthly feels manageable. That extra leverage isn't free. It bids up land. In a market where supply can't flex, the MID is like pouring a little gasoline on a fixed pile of wood. The flames get higher, not wider. This clicked for me when I looked at who actually itemizes. After the 2017 law doubled the standard deduction, fewer households itemize at all, which shrank the number of people who can even use the MID. That concentrates the benefit among higher earners who still itemize, exactly the group least constrained in bidding wars. So even though the headline value of the deduction narrowed, the price effect shows up where it hurts first-time buyers most: competitive, supply-limited metros. Let me show you exactly how this plays out for a buyer. Suppose you're choosing between a $550,000 home and a $575,000 home. The gross monthly looks similar, but with the MID, the higher mortgage's interest is partially offset at tax time if you itemize. That discount nudges you up to $575,000. Your competitor makes the same calculation. The accepted offer lands at $585,000, not because the house changed, but because the tax code nudged the bidding lane. Once you nail that, everything else clicks. The MID also interacts with rate cycles. When rates fall, refinancing resets the clock and encourages trading up. Historically, a culture of refinancing emerged around using lower rates to extract equity or move while keeping payments tolerable. The MID reduces the effective after-tax rate, making each drop feel a bit smaller in savings terms for itemizers, but it also normalizes carrying larger balances because some interest is subsidized. In upswings, higher rates combine with the smaller post-tax cushion to lock people in, reducing listings and reinforcing scarcity. The game changer nobody talks about is international evidence. Countries that curbed or eliminated mortgage interest relief, especially where supply could respond, saw cooling in price pressures compared with peers that kept it generous. It's not magic, it's demand math. When you remove a demand subsidy, buyers' ceiling drops and price growth moderates, particularly at the top end where the deduction was worth the most. Common myth: the MID makes homes affordable. The reason this fails is simple. Affordability isn't just the monthly payment. It's the entry price and the cash you need to clear it. By pushing up prices, the MID raises the down payment. Hurdle for everyone, including people who don't itemize and get no benefit. First-time buyers face a bigger cash pile to climb, while repeat buyers who itemize get the latter extension. Same market, different math. The tax code adds rungs for insiders and pulls them up for newcomers. Before we continue, you need to understand capitalization. In tight markets, every dollar of predictable buyer subsidy tends to show up in land values over time. The MID is predictable and broadly known. Sellers, agents, appraisers, and lenders price it in. If you remember nothing else about the MID, remember this: it doesn't create more homes. It helps existing owners sell for more and encourages buyers to take on more debt to chase the same roofs. Here's the shortcut nobody teaches. When evaluating policy, ask, can builders add units quickly? If yes, a buyer subsidy can pull forward demand without exploding prices. If no, it inflates bids and props up valuations. The US sits mostly in the second bucket. That's why you see the subsidy show up in comps, not construction. And boom, look at the result. Higher entry prices, larger average mortgages, and a tilt toward bigger homes where the deduction is worth more. The MID rewards leverage and space in markets already short on both. That's not affordability. That's a price escalator dressed as a tax break. Villain clarity. The code isn't neutral. It rewards bigger loans and bids in markets that can't build. Now let's turn to the second engine of inequity, tax-free gains, and how it locks in owners and locks out everyone else. Tax-free home sale gains, the capital gains exclusion. Now to the second engine, tax-free home sale gains. Section 121 lets you exclude up to $250,000 of gain if you're single, or $500,000 if married filing jointly, when you sell your primary residence, so long as you've owned and lived in it for at least 2 of the last 5 years and haven't used the exclusion in the prior 2 years. It's simple, predictable, and incredibly powerful in markets where prices have run far ahead of incomes. Why this matters under scarcity is the lock-in-cash dynamic it creates. In a world with tight inventory, owners know that waiting an extra year or 2 can convert a 5-figure gain into a 6-figure, tax-free exit. That nudges behavior. Hold until the windfall is big enough, then sell once and either downsize, relocate, or deploy equity elsewhere. The thing most people miss is that this reduces churn exactly where first-time buyers look, starter homes. Fewer listings mean more bidding pressure on what remains. Let me show you exactly how the incentives stack. If you bought a modest home years ago in a high-cost metro, appreciation alone can push gains beyond the exclusion threshold. That creates 2 thresholds in owners' heads: the 2 out of 5 years rule to qualify and the maximize the tax-free portion target. Many owners will time the sale to clear both. In the meantime, the home stays off the market, and new households compete over a smaller pool. There's also a geographic arbitrage play embedded here. High-price markets mint larger tax-free gains because the percentage move lands on a bigger base. If you sell a townhouse in San Jose or Boston and move to a lower-cost region, you can land with no capital gains tax on the first $500,000 of appreciation if married, plus a cheaper replacement home. That tax-free equity can then be redeployed into a larger property elsewhere, or even into investment real estate. The wealth effect is real, and it skews toward households already inside expensive zip codes. Before we continue, you need to understand step-up in basis at death, because it amplifies this. If a highly appreciated primary residence isn't sold during life, heirs typically receive a new tax basis equal to the fair market value at death. That means the lifetime appreciation is wiped for capital gains purposes. Combine that with decades of untaxed imputed rent and prior deductions, and you've got a powerful intergenerational transfer mechanism centered on housing.